Hi, guys, and welcome back to another episode of Cool Vibes with Key. I'm your host, Kiara, aka Key, and thank you for joining me for Financial Health Learning the Basics. So, we'll be talking about those finance and banking terms that you always hear about, but you might not understand why they're important, or you might have questions about, what are they actually? So, we'll be getting into those. But we won't be going over things like investing in this episode because those topics are much more complex and require a lot more explaining. If you want to see an episode like that, let me know. Whether you comment on one of my LinkedIn posts or in one of my Instagram stories, because I won't know to do it if you don't tell me. But let's jump into the first topic, which is banks and credit unions. What are they? What's the difference? Is there a difference? Let's find out. So, banks are for profit organizations that benefit a set of shareholders. There's few to no restrictions for membership, and they typically offer a very large service range. Most banks have pretty low APY and higher interest on loans and higher fees than credit unions. So, credit unions are nonprofit and they're ran by a board of elected members. So, you have to be a member of the credit union to be on the board of people who make a decision. There are restrictions for membership, whether it be belonging to a certain company, working in a certain industry, organizational ties, or geographic ties, like if you live in a certain zip code or state. Normally, they will have a smaller service range than banks, but are more personalized. And since they're nonprofit, they'll put those earnings back into the pockets of their members through higher APY, lower interest rates, and lower fees. Now, I've talked about APY a couple of times now. And so, what is that? APY is your annual percentage yield, and that's the money that your money makes for just using that bank or credit union. So, typically, a lower APY, you're not going to notice huge returns, and higher APYs, maybe you'll get $50 a month for having 10K in your account. So it really depends on your bank or credit union and the type of account that you have. So be sure when you're signing up, you're taking a look at what the APY is. Now, both of these are going to offer your core service of checking accounts and savings accounts. So let's talk about what those are and then get into the different kinds, of savings accounts. So a checking account is where you have your idea of check writing. And you also have, your debit card, your ATM access, and your ACH transfers. That's where you're taking money out of. It typically isn't sitting there in huge amounts. Savings accounts are like your little money vault. And that's just where you put money that you want to sit and you aren't going to use. In the US, these accounts are restricted to 6 withdrawals per month, and there's nothing hugely exciting about either a checking or a savings account. Now, there are options for savings accounts, so let's talk about those. First one I'm going to talk about is an MMA. An MMA is a money market account, and it's very similar to a traditional savings account, but they typically have a minimum balance requirement and offer a tiered style of APY. So the more you put in there, the more money you're going to see monthly or quarterly or yearly, however your APY goes into your account. Occasionally, these will offer debit or check writing privileges. So you do have to, kind of look to see if they don't have debit or check writing privileges. They are limited to the 6 withdrawals per month, like a traditional savings account. The next one I'm going to talk about is your high yield savings account. Now, this is the exact same as a regular savings account, but with a higher APY. These are great for putting your emergency fund, long-term savings. There's nothing too exciting about them except that higher APY that you see. So getting more money for letting your money sit. Personally, I use Marcus by Goldman Sachs. I know Ally Bank has a really good high yield savings. So you just got to do some research and see if any of the ones that have high yield savings fit for you. And the last thing that I'm going to talk about is technically not a savings account. And I know I said I wasn't going to talk about investing, but this is a type of investing, and it is called a certificate of deposit. The only reason why I am talking about it, though, is because most banks and credit unions offer certificate of deposits. So they're pretty easy to access, and there's not a huge amount of rules that you need to follow with them. So when I think of a CD, I think of it as kind of like a short-term savings account. So normally these come in 3, 6, 9-month intervals or yearly intervals. And during that time, your money sits in the certificate of deposit and it accumulates interest. The difference between a CD and a savings account is you cannot access your money during this time without being hit with fees for the most part. So these are really good for money that you know you're going to be holding on to for a long time. And you want that higher APY that's more similar to high yield savings, but maybe you just don't want that much sitting in savings. You want to try to start diversifying your portfolio, as they say. Whatever that may be, they're a good option. And CDs have 3 types. So there's fixed, there's variable or bump CD, and there's flexible or no penalty CD. So fixed CDs, you're going to put your money in for however long you say, and that's it. You can't touch it, and if you touch it, you get charged a fee. But other than that, that's the end of the story. A variable or a bump CD, you're going to put your money in for however long you want it to, and you start at a set APY. Let's say the market is doing really good. They might change your APY, from 4.2% to maybe 4.4%, and now it's going to stay at that rate, even if the market does a little bit worse. So they're still going to give you that 4.4 because it bumped up. And finally, you have your flexible or your no penalty CDs. So I know I said you get charged a fee for touching the money during that time, but a flexible or a no penalty CD, you can access your money during the saving period. However, there are usually restrictions on how much money and if you have to pay it back and whatnot. So no matter what kind you're doing, make sure that you're doing your research on fees, if there's fees to start it, what the APY looks like, if it's fixed, if it's variable, can it go down? You have to do the legwork. So while we were talking about high yield savings, I brought up the idea of an emergency fund. And, that's something that you hear all the time. You should have an emergency fund. You should have one. You should have one. But what is it? So an emergency fund is typically either 3 to 6 months or 6 to 12 months of your expenses that is saved and stored, usually in a high yield savings. So you're getting, that extra kickback of money. How much you put for, your 3 to 6 months or your 6 to 12 months depends on a lot of factors. Like job security, like if you have a really good job, you might feel comfortable having less in your emergency fund. If you have debt to pay off and expenses, your number of dependents, and really personal preference. Someone might feel very comfortable with, 1 month of savings, and they're like, that's all I need. So it really depends on that person. But at the minimum, I recommend 3 months. Now let's talk about financial goals. So you have short-term goals and long-term goals. Now, you can either define short-term and long-term by time or by size. So when you think about a short-term goal, that could be, your 3 to 12-month goals, or that could be something like saving for a trip, saving for an event, or to get a new bag, whatever that might look like. Whereas your long-term goals, those are going to be over a year of saving, or for something larger like a house or an international trip, and debt repayment. And then from your long-term goals, you also have your long-term investing. So there's a lot of options for long-term investments. You have stocks, you got bonds, CDs, EFTs, IRA, Roth IRA, 401k. The list is long. So when you're looking for long-term investments, do your research on, what you want. And the other tip that I say for long-term investing is go to a financial planner. They're going to have a better idea of how to mix and match different long-term investments to best suit your, ideas of what security looks like and what your goals are. And for our last section, we have credit cards. So credit cards are, I wouldn't say better in a ranking sense, but in a security sense, credit cards are better than a debit card because they offer more security. The way that debit card agreements are written, it's usually very hard to get your money back if your card is misplaced or stolen. And so credit cards offer an easier process for that usually. I never recommend that you use your debit card if you don't have to. But I do recommend that you treat your credit card like a debit card. And when I say that, I mean pay it off. Don't leave a balance sitting. Don't let your money, get hit with those really high APYs because you're just paying more money than you need to. So treat your credit card like a debit card. So what are some good first cards? Now, both of these cards that I'm going to talk about are both my first and my second card. So that's why I know about them. But of course, there's a lot of options out there, and I always recommend you go look at these cards, look at other cards, see what fits you best. If you want to commit to one kind of ecosystem and stay in it, that's completely up to you. And when I say ecosystem, I mean, you have your Amex people, you have your Capital One, all these different, sets of cards. The first card I'm going to talk about is the Discover Egg card. So like I said, this was the first card that I had. And I think the best thing that they offer is identity protection with your standard card. So they're checking to see if your email is found like on the dark web, if any of your passwords are compromised. Different addresses are associated with your name. So that's a really good base feature that they offer. And the cards are also customizable, which I think is fun. So my card is maroon. But the biggest downside of Discover is they aren't accepted everywhere. Some places will have restrictions, and it's typically no Discover, no American Express. That's why I got my second card, which is the Capital One Quicksilver. One of the unique things that they offer is one-time card numbers to use for online, which is pretty nice, and Visa is very widely accepted. Both of these cards are going to offer locking in the app. So if your card is misplaced or stolen, you can go on your phone and just lock the card. That'll keep any transactions from going through. You can alert them of a trip beforehand, so it doesn't lock, when you're traveling. And they both do offer cashback. So Discover also has, your typical cashback, and then they have their little cashback calendar, which changes to 5% return on, certain places during the quarter. So they're both good cards. And when we're speaking of the good, we have to speak of the bad. And while I don't have bad credit cards, I will say for any account, whether it's checking, savings, credit card, I don't recommend that you have to pay to maintain them. It's your money. Especially if it's just sitting there, you shouldn't be paying for it. And with the bad, I also have a nice short list of banks that I use a lot of caution dealing with and that I would personally never have an account with. So that would be Wells Fargo, Chase Bank, Bank of America, and Citibank. Of course, I always recommend you do your own research, but these banks just have not great track records, especially Wells Fargo. Wells Fargo was born out of the ashes of a bank that was forced to close because of the exact same issues Wells Fargo faces now, which is, opening random accounts, charging random fees, things like that. So make sure, no matter where you're opening your account, that you're doing proper research on the institution that you're putting your money into. So I hope you guys enjoyed this week's episode and that you join me on the next episode. If you want to keep up with all the different things I'm doing, I'll make sure to leave a little link in the description for, my Instagram, LinkedIn, all those fun accounts. But until next time, bye guys.